The title of our story today is Technical Analysis in Trading. There's so much noise. How does anyone make sense of this mess? Fred wondered aloud. Ah, young trader. To see the truth, you need the tools of a technical detective, Pip advised. Part 1. What are technical indicators? Technical indicators are tools that analyze price and volume data. They don't predict the future, but they help you read what the market's been doing, Pip explained. So they're like clues from the past? Fred asked. Exactly. The market has a memory, and these indicators help you interpret it, Pip confirmed. Part 2. Moving averages. The market's memory lane. Let's start with the moving average. It smooths price over time. You'll see two types a lot. Simple moving average, plain average, exponential moving average, EMA, gives more weight to recent prices, Pip explained. Visual price, simple moving average, SMA, is a plain average, while exponential moving average, EMA, gives more weight to recent prices. Fred asked if it's like a trend guide. Pip answered, bingo, it shows momentum and direction. Think of it as the market's mood ring. Part 3, RSI, overbought or oversold. Pip introduced RSI, saying it's the relative strength index that shows if a pair is overbought or oversold. Fred asked how it works. Pip explained, RSI ranges from 0 to 100. Above 70? Too hot to handle, might be time to cool down, sell. Below 30? Oversold, could be a buying opportunity. Fred compared RSI to the market's energy meter. Pip winked and said, exactly, too much hype or too much fear. RSI shows the tension. Part 4. One tool does not equal one answer. Pip cautioned Fred, easy Sherlock, indicators are clues, not guarantees, and using too many creates confusion, not clarity, Pip explained. So, one or two good tools are better than a crowd? Fred asked. Right. Combine a couple smartly. Like moving averages plus RSI equals trend and strength, Pip replied. Technical indicators aren't magic, they're just lenses. Use them to read the market more clearly. Okay, I'm starting to see the story in the chart, Fred said. Great. Next episode, we dress up for the big dance. MACD and Bollinger Bands are next, Pip announced. Forex trading, technical indicators. Pip, are we going to a Forex costume party or something? Fred asked. You could say that. Welcome to the technical indicators prom. Time to meet two more powerful dancers, MACD and Bollinger Bands, Pip replied. Part 1. MACD, the trend tracker. MACD stands for Moving Average Convergence Divergence. Sounds fancy, right? But all it does is show you momentum and trend shifts, Pip explained. How? Fred asked. Simple. Watch for the MACD line crossing the signal line equals possible entry or exit. Histogram bars growing means trend strength. Bars shrinking or crossing zero means trend might be weakening, Pip said. Green histogram bars grow taller as trend strengthens. So it's like a dance? When they cross, time to act? Fred wondered. Exactly. It's the MACD crossover boogie, Pip confirmed. Next up, Bollinger Bands. They measure volatility, Pip explained. Volatility? Like how wild the market moves? Fred asked, curious. Yep, BBs have three parts. Middle is moving average, upper band, lower band, Pip said, explaining. Bands expand wide during major news. Contract tight when calm, the narrator added. When the bands expand, the market's volatile. When they squeeze, a breakout could be coming, Pip informed. Fred nodded in understanding and said, so the bands are like pressure sensors? Exactly, and price tends to bounce between them until it breaks free, Pip affirmed. Part 3. Not a crystal ball. Careful, indicators don't predict the future. They guide decisions. Don't overload your chart, Pip warned. Fred sounded frustrated. I can't even see price anymore. That's the trap. Too many tools can blind you.